if you don't have at least, 20 or 25% in some sort of a cash mode, we own short-term treasuries, but 3 6 month treasuries, that kind of thing. If you don't have at least that much right now, I think you're taking a bigger risk because valuations are still really, really high. We're still at a high multiple S&P. And what happens in tough times, is they shrink the multiple and they shrink the earnings both. And that's how you get hit. And I don't think people are factoring any of that in.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Very happy to welcome back to the program Ted Oakley. Ted is founder and CEO of Oxbow Advisors, a high net worth advisory firm. Ted is one of the absolute true gems of the investing world. I always love getting to interview him. We've got a lot to talk about. Ted, thank you so much for joining us.
Good to see you, Adam.
Good to see you, Ted. And I think the audience is going to particularly appreciate your calm, just level-headed, quiescent demeanor here at a time where there's a lot of concerns swirling around Wall Street right now, right? We've got spiking oil prices from the Iran war. We've got concerns about private credit, potentially spilling over into other parts of the credit system. The stock market's basically gone nowhere for pretty much 6 months at this point. I don't even know where we should start. From your perch, what are you looking at most closely these days with your team at Oxbow?
Well, Adam, we look at companies from the companies themselves, and we'll wait till we get certain opportunities to own things, and that presents us with a few things. Rates ticked up a little bit, and so we've been able to buy a little 2 and 3 year paper that were better than normal, but we've really picked off some things. I mean, you have to, for us, we look at the companies as opposed to like the overall. If we have a certain level, we want to own something, then we'll own it. I mean, I know there's a lot going on for sure that's affected it, but we were in pretty good shape on all this. I think the economy, if this thing keeps on going, obviously it's going to suffer. I mean, you've got diesel prices over $5 now, which is a big, big factor, even more so really than gasoline when you think about it for shipping. And I think we got to run into some headwinds, no question about it. But typically, if you have quite a bit of liquidity like we do, it actually sets you up for a period where you can own things that you might not be able to own before. And so that's the way we view it. A cheap price for us is an entry point, not necessarily a place for us to get spooked about the market.
Yeah, and you have said many times in your previous appearances on this program that your firm's best years have been coming out of bear markets, right? And so, part of your strategy is keeping enough dry powder so that if and when a bear market arrives, you can withstand it well and then have capital to deploy when valuations are really attractive. Now, we're not in a bear market yet, and while Wall Street has been a lot more volatile, and like I said, the tenor there is much more nervous now. We're still not that far from all-time highs, right? We're down like 400 S&P points
Yeah.
from the all-time. So I guess let me ask you this: have you made many material changes to your portfolio based upon what's been happening, especially since the outbreak of the war, or are you just kind of steady Edding, just sticking to your original knitting?
Well, we sold at the very end of the year, last week of the year, and the first week of the new year, we sold some of our gold miners. So basically sold almost all the silver itself when it went to 100, and so silver miners. So, and we really we sold a little bit of gold, but not much. We usually don't sell much of the gold itself, but we did the miners. And what happened really in the last month is that particularly the gold mining royalty companies with 3 we own, they came down about 30% or 35%. So we bought some of those back, and then on the energy side, what happens on energy is that the service companies, drilling companies, service companies, they come in at the end they start to move later than the producers themselves. And we own the producers as well. And I don't know if people probably don't know this, but oil and energy was our biggest holding last year coming into this year as far as amount that we have in a portfolio. And so obviously it's been a good period for us, but we haven't done anything real unusual other than if we find a company that's cheap, we're gonna add it when we've added a few. And so that's pretty much what we've done here. We're still carrying, overall, probably 45 to 48% in U.S. Treasuries.
All right. So you've got a fairly high cash balance, and again, that's going with the strategy of
Yeah.
making sure you've got dry powder on hand if lower valuations present themselves. I'm curious, is energy still your largest single holding there at Oxbow right now?
It is, and we've actually we've added a driller, added a service company or two, and we don't really feel like that's something that's just a flash in the pan right here. We really feel like they're still fairly cheap. They pay good cash flow, good dividends, and so it's still the largest holding for us in general. Yeah.
Okay. Okay. So I want to talk more about energy, but I want to relate it to the precious metals. So the precious metals just had a phenomenal run, especially going into the end of last year, right? I mean, silver started the year around $25 or so, 2025. Ended the year zooming into the 100 bucks an ounce range, and then catapulted to 120 very quickly, and then has had this, it's basically been cut in half more or less since then. Um, so that was sort of an example of a sector just getting ahead of itself price-wise, right? Just had so much price appreciation in a short period of time. I'm presuming you said, guys, look, it's been too good too quickly. Let's de-risk here. Certainly proved to be the right move. Sounds like you're seeing some all clear signs there, so you're getting a little back into at least parts of the space, like the silver or the precious metal streamers or royalty companies you mentioned. With oil, it's a little bit of a similar story. I mean, not quite as extreme, but you and I talked last year a couple of times about how oil was starting to look like a place to put capital back to work in after years of it having been kind of a pretty underperforming sector. The oil stocks did really well at the beginning of this year, and this was pre-war. But they had a lot of price appreciation. I mean, I would say kind of on average, like 25, 30% for a lot of the names in that sector.
Mhm.
Now we've had the war, which has pushed prices up even higher. Uh, Sorry, oil prices up even higher, which presumably should help a lot of these producers and other companies in the space, at least in the near term, profit-wise. I guess my question is this space starting to get ahead of itself, or do you think it has sustainable legs to run from here? I'm presuming it's more the latter if you still hold it as your largest core position.
Well, we certainly think it has more to go, and you have to remember, not many people own it. If you look at most of the money on the East and West Coast, for example, that are in pension plans, endowments, and that sort of thing, they have totally turned off and kicked fossil fuels out of those portfolios. They don't even own any. It's almost like they don't even know what's going on in the rest of the world. And so you've got a whole group of people that don't even own it. A lot of institutions don't necessarily own a lot of oil, and they claim to have energy, but it's off the wall stuff. I mean, it's wind energy and that sort of thing. But they're missing the point here that, fossil fuel is probably going to be the place it's going to be the next 2 or 3 or 4 years. And even withstanding, if everything goes back to normal in the Mideast, you're still in a situation where it's cheap. And we haven't, a lot of people don't own them. And you only have about less than 3% of the S&P that's in energy, oil.
Right.
So, yeah, I think it has more to go. I mean, it's like it hasn't ever gotten the level. Like, for example, when the gold miners hit such highs, we basically cut those in half uh, right at the end of the year, beginning of January 2nd, 3rd, or 4th. And we did the same thing with silver. We owned Hecla. We cut that in half on the silver miners because it tripled in a year. And so it was a thing to do. Well, all of those have come back now, and you have a lot of retail in those stocks. In energy, you don't have as much retail. They're not chasing those things. It's more of a steady climb where people are starting to realize that, hey, we're going to need this, and it's going to,
Hmm.
no matter what, it's going to be a while before they get this thing resolved in terms of getting back to normal. And it may never go back to normal for quite a while. So I think you have to stay with energy in here for the time being.
Okay. And I'm curious, I love talking to folks like you who are based in Texas, because you hear the conversations about the oil industry that are being had in the oil industry around you. Is there anything notable that you're hearing right now, either in terms of optimism about the future or, any general vibe coming from the folks that actually work in that industry?
Well, they like the price. What happens with energy in the oil fields is that it has to go for a while before you're going to see them say, okay, we're going to start to increase drilling and do that sort of thing. And people forget that with horizontal drilling, it's not like when you would raise a bunch of rigs when you were vertically drilling. It's a different game now. But they like the price, and a lot of the producers in Texas and the Southwest really have gas, and gas is not as the price is not as strong, so they're not getting that much revenue. But in the oil, they're just they like the price right now, and they'll take it. Uh, and I think if you sustain the price or you drive it higher, then you'll start to see maybe an increased drilling because they'll come out of the woodwork then and say, hey, it's time to do something.
Okay. One of the questions I've been asking folks, I'd like to get your thoughts on, Ted, recently, which is, this is a conclusion I'm increasingly coming to, and I am not an oil analyst nor a geopolitical analyst. But it seems pretty reasonable to me that there's going to be a higher risk premium placed on oil and gas coming out of the Persian Gulf in the future. Hopefully once this war stops and the dust starts to settle, and nations that buy from the Gulf are going to say, you know what, like, yes, it was nice buying, oil and gas from there. But I'm just so uncomfortable now about sending my ships there and worrying that the region might, turn into a flashpoint again, or a mine might hit my boat, or Iran might, start demanding a toll for my tankers to go through there. And so I want to start thinking about sourcing more of my fossil fuels from, more stable, quote unquote, safer countries. And the administration's been saying, yeah, we've seen this already. We just signed a $56 billion worth of energy deals with Indo-Pacific countries recently. They're ringing their phones off the hook, saying, "Hey, can we buy more from you going forward?" And a lot of these countries. Let's talk about Japan.
Mhm.
Japan buys a lot of fuel from the Persian Gulf. It takes 25 days to get there. Well, if they buy from America to get it to them from Alaska, that's only 8 days. And they don't really worry about Alaska turning into a war zone. So do you think that there may be some long-term benefits coming out of this war that may actually be additional tailwinds to America's oil and gas industry?
Yeah, I mean, all of that could happen. I don't know. You're talking about moving the oil, but if you look at tankers today, one of the problems about the all the tankers over there is they don't have any insurance. It's not so much they can't get through the strait, but if you don't have, they gave them 7 day outs on the insurance, so they don't have
Right.
any insurance. So if you don't have any insurance, you're not going to. I mean, you may run into something. It has nothing to do with the mine or anything else, and so that's the one of the biggest problems nobody talks about in that regard. But yeah, and I think as we own one tanker, DHT, and it's been good for us. But I think and it has a young fleet, no, the debt's low, all that sort of. It's the best one, in our opinion. But the thing about it is that yeah, that could very well happen that way, especially if it goes on longer, a lot
Hmm.
longer. I'm talking about where they just can't get anything resolved over a 6 month period or something.
Well, let's talk about that risk too, just to the general markets, right? So presumably, the longer the war goes on, the longer oil prices are going to remain elevated. Maybe they'll go even higher, right? I mean, one wild card here is how much damage will be done to the energy infrastructure of the Gulf by the time this is over. Hopefully no more than already has been done, but it could get a lot worse. But the longer this all goes on, those high oil prices just weigh on the economy, right? It's just higher input costs. They start even crimping supply chains. We might have some of the echoes of what we had to deal with during COVID. Um, how worried is that starting to make you about the general markets as the thing that triggers, a really material correction in the financial markets?
Well, I don't look at the markets exactly and that this. In other words, I look at where the S&P and the NASDAQ are and that sort of thing. And I will tell you, they're right down on their 200-day average.
Right.
I don't use technicals a lot. I know how to use it a lot, but I particularly use it when you're breaking these levels like that. And you're right down on those levels. So if anything gets a lot worse and you start to break those levels, then all of a sudden you end up in a situation where people pile on, so to speak, and you get more
Hmm.
selling than you expected. The one thing I've always known in this business is we know nothing about the future. I don't know anything that's going to happen. But you always have to have a portfolio that can operate under any circumstance. In other words, if you're going to have a market that really just keeps right on moving, things are great, that's okay. But if you break it and things get really, really cheap, how are you situated then? Are you in a situation where you can take advantage of it? And I think that people need to think about having sort of an all-weather portfolio rather than trying to stay fully invested in 12 exchange rated funds and just forgetting it. I just don't think that's going to work the next 5 years.
Okay. Just for folks that maybe don't know exactly what you mean by all-weather portfolio, generally, what are you talking about allocation wise?
Well,
Presumably
you're
there's a
gonna,
big chunk there to
yeah,
cash
you're gonna have to
equivalents.
have some. You don't have to have as much as we have necessarily because we've really done well the last couple of years, even with a high allocation. Because if you own the right things, it's going to work.
Hmm.
But what I mean by that is always have a portfolio such that no matter what happens in the marketplace, if you unfortunately have, say, a move down that's really tough, I'm talking 30, 40%, you can weather that. In other words, you've got enough liquidity so that you're okay and let that thing come back on its own, what you've got invested. If you don't have any liquidity, you can't do that. In other
Right.
words, everything you have is down at that point, and you need something in a portfolio that doesn't get hurt in those kinds of times. And consequently, on the way up, as you go higher, and things are doing really, really well, and you have these major moves in stocks, you need to take some of them off. In other words, you need to try to set that up so that, eventually those names will come back, they'll sell off some. So it gives you a chance on both ends to participate. That's the point. You can't just put everything in a market portfolio and say, I'm good to go.
Hmm.
We just don't believe in that.
Well, and I'll talk more about this at the very end, but I am an Oxbow client, and one of the things that I have very much appreciated it has been the performance, especially of late, but also with sort of that higher margin of safety, where you've got a fair amount that's in either just cash or it's in short-term treasuries that are paying an income along there, and so it just really helps you sleep at night, I guess is what I'm saying, is when you know that you're not fully exposed to the market, and yet you're still seeing the type of progress you want to see in the overall account balances. Um,
I would say this, we've had more trading in the last really 5 or 6 months than we normally do. But because that's why we know how to do it. But the main point is that I think we'll go into the next 5 or 10 years and things will change. You can't just be fully invested all the time. There'll be periods when you need to know how to raise cash. Um, I'm writing about that in the April comments that'll be coming out. They're entitled "The Gambler," but I got that Kenny Rogers song about know when to hold them and when to fold them,
mhm.
and that's the point. There's times when you need to know when to deploy cash and times when you need to raise cash. But I think that's right now in the investment community on the advising side, That's an art that is only displayed with a few people.
All right. Well, so this is sort of why I asked that question about your level of concern about high oil prices maybe being the trigger here that sends the markets into a material correction. Because on many of your previous appearances here, you and I have talked about your level of discomfort with valuations,
Yeah.
that they've been historically rich, right?
Mhm.
And so I guess maybe if I can distill my question down and ask it again, is this a time to fold them? Are you concerned enough that you're saying, look, we're actually adding to our cash balances because we think the odds of lower prices ahead is now more likely?
Well, I would say to your viewers out there, if you don't have at least, 20 or 25% in some sort of a cash mode, we own short-term treasuries, but 3 to 6 month treasuries, that kind of thing. If you don't have at least that much right now, I think you're taking a bigger risk because valuations are still really, really high. I mean, if you look at the CAPE ratio is still really high at, 40 times. Your if you look at future earnings for the next 12 months, high multiple on that stuff. We're still at a high multiple S&P. And that doesn't factor in anything. And what happens in tough times, is they shrink the multiple and they shrink the earnings both. And
Hmm.
that's how you get hit. And I don't think people are factoring any of that in. And I'm not saying it's guaranteed to happen, but if you don't have any liquidity right now, you we think at least that you should have if you want to try to get through this period in here. And I've said this before, we're in these second years of presidential elections, and these people do all sorts of things during this year that are negative and positive. And so you never know. Second years are not very good, by the way. So I think that's on top of
Not
what's
very
happening.
good on an average market return
Yeah,
basis.
average
Yeah.
return is 1%, so, and we've had some really negative years in second year terms.
Okay. What I guess the question I want to ask is what risk factors are you most concerned about right now? We've talked about valuations, we've talked about high oil prices. There's the concerns that are, we're seeing in the headlines at least about private credit and some worrying that that may lead to a contagion that could be problematic. You also mentioned earlier too, just higher interest rates, right? So that's good for folks that are owning short-term treasuries like you, but it's bad for companies that are trying to roll over maturing debt and whatnot. So is one of those four factors what you consider to be the biggest risk factor right now, or is there something else I haven't listed?
Well, the higher rates, Adam, will also affect private equity and private credit. So
Yep.
they'll go hand in hand. And I think people, when they look at, they look at their bond. If you own long-term bonds, we've said this really for the last 3 years. Really, you really can't own the long bond like the 30-year paper and that sort of thing. And you look at it now, and just give you an example. We bought a Berkshire Hathaway 3 year bond on a 467 just today, okay? And yet you're like 488 or 489 on the 30-year treasury. Think about
Mm,
that. Think about that. I get almost the entire yield from maybe a better credit than the treasury. And I don't think people think about that when they're looking at things. They just sort of throw it in a fund and hope it works okay. But yeah, you're really seeing this private credit come unwound. But it almost had to. They had like Wall Street overdoes everything. They've overdone
right.
private equity, they've overdone private credit, and every family office that I know of has got some of both because they were sold it by some consultant. And people don't really know what's in those things. And now they're having to, if you go look at the first quarter, I got the graph today of redemptions from the top seven, okay, is huge. I mean, it's amazing looking back over the last 4 quarters what's happening in that. So people are saying, hey,
So it's a high redemption rate, even though they're starting to gate withdrawals.
yeah, well, they're gating it, yeah, but it's still overall, if you just look at the firms, if I can give it to you, if you look at the firms, they're they're really, if they haven't gated it, they probably will. And it just goes to show you, you can't trust Wall Street. You know, you look at private equity, private, and they did this years ago on hedge funds. They learned the lesson. They should have, and they'll gate them every time because they look out for themselves first.
Yeah. So I just had produced Thoughtful Money's Spring Online Conference this past weekend, and one of the members of the faculty was Matt Taibbi, the great
Yeah,
chronicler of the great financial crisis,
yeah, interesting guy.
and a great guy. I mean, super smart guy, but also just one of the nicest men you could ever hope to meet. And I asked him, uh, if he saw, if he heard a rhyming in what's going on with private credit versus, the credit issues back in 2008. And he said, yeah, absolutely. And I said, well, so from your perspective, what have we learned? What did Wall Street learn coming out of GFC until now? And he said, basically nothing.
Oh.
Basically learn that it can continue doing what it's doing and still pay itself record bonuses along the way and probably have a high degree of confidence it's going to get bailed out.
And the problem too, Adam, is that, for all your listeners out there, uh, gating means they can cut you off. You can't get your money out. I
Right.
mean, it's a term we use on the street. But, when they went in to allow individual investors to get pieces of all these things, they didn't know what they were buying.
Hmm.
Somebody sold it to them and they end up, again, I've always said this, but you really have to know what you own in a portfolio. I mean, the companies we own, you know them. I mean, you would know them, but you have to know what you own. You can't just own something that somebody said, "Hey, this is a great thing. You need to go into it." And that's sort of where that stuff went to.
Yeah, and I think you and I have talked about this, but it's really hard not to look at the push to bring retail into the private markets
Yeah,
as a way for the private issuers or the private investors, the big ones, the institutional ones, to basically pawn their poor performing assets off onto an unsuspecting public, right? To your point, hey, these people don't really know what's going on. We'll get them excited that, oh, you get to get behind the velvet rope and invest in the same thing that the big names do. But we're going to take basically the junk on our books that we don't want and sell it to the retail client. Do you feel that that's pretty much what's been going on?
well, I totally agree with you. Exactly. I told somebody the other day, I said, hey, if you really feel like you need to go buy some private credit, why don't you just go buy a few rent houses on your own? Because you can
Hmm.
control that, okay? And because you can't control this other situation. It's just like everything on Wall Street, though. The early players make money. The early players in private credit did well. The early players in private equity. But
Hmm.
see, Wall Street ruins everything. I've seen this with computer leasing, with tech, with drilling rigs all over the years. Now it's these two. They overcapitalize it, and so what happens is you end up they spend too much money, so they buy everything and they overpay for it. Like you're going to make more money, I think, in the straight S&P than you will in private equity when it's all said and done.
Done. Yeah. Yeah, which of course is so contrary to the narrative of why you want to buy, private assets. But yeah, and I completely agree with you. So your point about, really knowing what you own, obviously it's foundational advice to any investor. But at Oxbow, in addition to interviewing you, I interview your chief investment officer, Chance Finucane, and Chance, I mean, essentially, his time is basically just spent building that watch list. I know working in conjunction with you and the rest of the team there at Oxbow, but then just really living and breathing that watch list, right? And determining when something on it,
Yeah.
rises to or maybe falls to a value that makes it, worthwhile to consider putting it in the portfolio, or looking at the existing portfolio and saying, hey, we loved this company when we first bought it, but now this has changed, time maybe to prune it. But it really is about developing a mastery over a portfolio of individual companies, correct?
Totally. And I'll put in a plug for him. He's as good as there is. And I've been
Mm.
around this business a long, long time. And I will tell you, he's a great partner, owns part of the firm, and he is an excellent, excellent guy in the stock market.
All right. Well, folks, we'll be having Chance back on the program in I think like 2.5 weeks. So you'll get a fresh crack at what Chance is seeing as well. Um, all right. So, I don't get the sense, and correct me if I'm wrong here. I don't get the sense that you're entering a batten down the hatches moment in the markets yet, even though you are concerned about current valuations and some of the risks that we've talked about. What would get you there? What would you need to see to start saying, you know what, this looks like a bear market could be starting here, and we want to go into sort of full bear market mode, whatever that looks like for Oxbow?
Well, a couple of things. Number one, if rates really went higher, now I'm talking about 2 points or something higher than they are now, you're going to throw yourself into a big recession. And oil the same way. If you look at the 74 bear market, what kicked that off was the embargo. It killed everything.
Hmm.
And you went into a major recession and prices went, that was the cheapest, that 74 low are the cheapest prices that have been since then. I mean, they were low in 82 too, but not, that 74 low was dirt cheap. And it was because you were really into a recession and you had inflation. I mean, it was crazy. It was a mess, and
Hmm.
that would that would bother us to have both of those things happen at the same time. Have really high oil, really high rates, because you're going to damage a lot of people then. I mean, not just you're going to damage the consumer, which our economy runs off of. You're going to damage companies, and then that's what I was talking about. Then your earnings are going to go down, your multiples are going to go down, and that's how you get into these severe bear markets. Both happen at the same time. Um, and as far as I'm concerned, we're still in what some people would still call a bubble because the prices are still very, very expensive in these markets relative to where they have been, say, in the last 50 years.
Okay. I will tell you that fear that you just mentioned there, that is Luke Roman's current outlook from what he just shared at the conference. His big concern is that we enter essentially a stagflationary recession because of the high oil
Yeah.
prices and the high yields throwing everything into this recession. So sort of history repeating again.
Well,
Um,
I know Luke's a great guy. I'm sure he did well for you because he's a very knowledgeable person, that's for sure.
well, what was so wonderful about the conference is, and this is why I love doing them, is the mission of this channel is to help the average investor, look through the eyes and crawl around in the brains of people who have decades of great experience, and you're certainly one of them, Ted. And I feel like everybody I bring on the channel has, one to several kind of pieces of the puzzle. And over time, we're collecting more and more pieces of that puzzle, as I interview people week after week on this channel. What's fun about, or what I think is really valuable about these online conferences, it's 11 hours. I mean, it's like 15, 16 of these speakers all right after the other. And I feel like you get a lot of pieces of the puzzle all at once. So you walk away from the day, I think, with a much clearer view of what's going on, at least right now at this snapshot in time, than you're able to get just, watching week after week after week. So we had a number of people. There's certainly some differences of opinions on exactly how this is going to play out. But if I had to say there was sort of a majority view, it's that there is a shock that's happening right now to the economy. It is going to be inflationary in the short term. And then the question is what happens after that? And like I said, Luke sort of thinks we get stuck in this stagflationary recession. Though like Lacey Hunts and Ed Dowds of the world, they see this same potential in the immediate term, but they have got they've got larger concerns about the economy and its weakness that they had before the war broke out, and they think that this oil shock, essentially, even though it's inflationary initially, is just going to add insult to injury on where the economy was before, and that things are going to then dramatically slow. And as Lacey says, oil shocks, while initially inflationary, are actually deflationary in the long run. And so they predict more of a sort of disinflationary, deflationary recession to be the legacy of this oil shock. So we'll see what comes out. But again, a lot of people sort of think what's happening right now is not good. Like
Yeah.
there's no good that's going to come out of it.
Well, I suppose unlike Lacey and Luke, I don't know what's going to happen
Yeah.
for sure. And I never have since I've been in the business. But again, you just got to be ready to play a hand either way. I mean, that's really what it amounts to.
Well, you and I talk about the sports that we play when we're off camera, Ted, and I think it's that sort of athleticism, which is, really one of the things I see as one of the strengths of Oxbow, which is, you sort of mentioned the all-weather portfolio, but it's the ability to be reflexive to what happens. You've got your core holdings and your core framework, but you've got the ability to kind of, pivot and react to some of the larger macro developments as they happen, if you feel it's worth, changing the portfolio structure for that. But I get a sense you don't change the portfolio structure to macro events very often.
Not very often. I mean, we change it relative to companies. Or a company gets too high, like we had with the gold miners, and sell some of those back then.
Hmm.
But again, we bought some of the, just in the last day or two, bought some of the royalty companies back. But Adam, at a really low point in a bear market, if you and I were having this conversation, we will have to be, people will be, you have to drag them to the altar to buy stocks. And they'll be cheap, but you have to drag them in to buy them. And actually, that's where they'll make the most money. But that's when you have to be able to say, hey, look, you're going to own a piece of a company here that makes this much money, that will do well over the next 5 years. And if you had all the money in the world, you'd buy the whole company right now. That's when you can make sense to people rather than playing off of their fears at lows, like, hey, I hear you, you need to get out. That's not the right thing at that time. If they had enough liquidity, they can take advantage of some really good pricing. And really, they need to take advantage of higher pricing too and sell some things.
Hmm.
I mean, if you look at these big 7 or big 10 stocks right now in the S&P, you'd be better off to sell some of them. We've sold some of them, a lot of them.
So let's dig into that just for a minute, Ted. So, I mean, first, let's hope this war is over tomorrow. Let's hope the administration is correct and that the oil shock's going to be fleeting and it's going to, in Trump's words, drop like a stone after the war ends, and that everything the administration has been saying is going to provide a tailwind to the economy this year from the one big beautiful bill and the deregulation and the tariff revenue and all this stuff. Let's hope that all happens and we actually end up having a great year. But we got to be realistic about the current challenges that we're facing and the uncertainty that's there. So, to your point about a bear market, I'm not saying this is going to happen, but let's assume for a moment that these events actually do trigger, a bear market in the financial markets. Um, you have said that investors, as the fear begins to build, they start making a lot of really bad decisions, and they get to a point where they just have zero appetite for stocks anymore. And they generally tend to flush out their positions, oftentimes near the lows. And when it's the best time to be buying, they're allergic to the idea. But again, you've said that's where time and time again over market cycles where you've actually had your best performing years is coming out of a bear market. So what would you advise the average investor to just mentally prepare for, assuming for a moment that a bear market lies ahead?
Well, if you make that assumption and you say that's going to be, you need to have enough money, I'm talking about set aside liquid
Yep.
wise, so that let's just say that you don't know this, but it's going to be a 2-year bear market. Because I've been through numerous of those. And what happens is they just eat away at you every day. The market opens up in the morning, and by the time you get to the afternoon, it's down again. And
Hmm.
people keep buying, think I've got a low, I've got a low, I've got a low, but it keeps on coming at you. You have to have enough money to sit out the market at least to see where were you going to get to here, and not apply all of your funds at one time. This whole business and cheaper prices is about scaling things. You can buy a little bit of things and buy a little more later on. But I think you have to have enough money, enough so that if you look out over the next, say it's 2 or 3 years or something, you can wade through that. If you have everything in the stock market and every day you get up and it's lower, for example, that's going to be a problem. And what I see out of this real expensive market right here is one of two things. Either you really get a significant sell-off that sets everything back cheap again, all in one throw, like within a 6-month period or something, or you don't make any money for 7 or 8 years. In other words, it's a 3% return, 2% return
Right.
for a long period. And you've got to be, to me, you have to have enough liquidity either way to work through those things.
So Ted, there's a lot of people that are watching this video here who are older, 50 years older. We've got plenty that are in retirement. A lot of them have been, successful and successful enough to retire. But I don't know how many of those people would be able to withstand 7 or 8 years of going nowhere,
Yeah.
right? What would you advise somebody who's watching who sort of fits that criteria do? I don't want to encourage panic. I don't want them to make any rash decisions, but I guess what kind of conversations should they be having, perhaps with an advisor, just to review their situation and kind of just do a stress test to say, okay, look, if we entered a bear market, if I took steps X, Y, Z now, might that actually help me weather it better?
Well, it's interesting you bring that up, Adam. I'm thinking of a new book. In fact, I've been talking to staff about this. I've got a lot of stuff lined up on it called
Hmm.
Thin Ice, and it's about people over 65 that are in the market because a lot of them are fully in the market. They don't they're like out their portfolio is 90% stocks. We see people 70-year-old, 80-year-old people that have 80, 90% in stocks. All right.
Mm.
And there used to be an old saw on Wall Street, and still around, but said that, if you take 100 minus your age, that's probably about what you should start to look at in stocks. In other words, as you get older, you settle things down because you don't know what the future holds, and you got to make sure that you're okay. And
Hmm.
obviously, at 70 or 80, you don't have as long to live as you do at 40. So, you got to start thinking about that because I think they're missing the point. It's been great for a number of years, and all the advisors are telling them, hey, you don't need that safety valve. You stay in the market. It's done great for you. And they have great profits, by the way. And so it's hard to get them to understand that. But I think they should understand it because right now, if you had a major bear market with people over 65 or 70, I think it would really, really affect them a lot. I don't think they're ready for that. And I think the biggest problem they'll have is it emotionally will affect them more than it would have at any other time. You got to realize, next year, the average baby boomer will be 72, which means they got to
Hmm.
start taking money out of all their pension plans. And secondly, back in 2000, you know, they were 45. So that's the difference, see, and that's what you get into. You had plenty of time back then as a baby boomer. You could wait on it. But man, not at this stage. You have to do it. I just think they're missing the point. And I know it's going to be hard for them to say they raise liquidity and do something different, but they should think about that for their own benefit, I think.
All right. I think that book would help a lot of people, and I think there'd be a lot of interest in this audience at it. And you do such a wonderful job of writing these books, and very much in a very digestible way, but you generally make them free to the public. Is that your plan for this book as well?
Yeah, I doubt if I can have it finished until the end of the year, but or the fall at least. But yeah, that would be it, and it won't be that long a book because I can give a lot of facts and a lot of graphs and a lot of things about this age group uh, that'll ring home with them. And the Federal Reserve's done a lot of work on that too. They've got a lot of great graphs at Fred that you can look at and see what the numbers are. But they're all-time high, all time. And I mean, when as far back as they have records. So we know they're all in and all in a big way right now.
Yeah. And when you say all-time high, you mean percent of stocks.
Percent of stocks.
Yeah.
Yes.
Yeah. It's the highest. Well, yeah, it's the highest ever, but it's certainly the highest ever amongst the retired cohort. I've seen those same charts. And Ted, your advice here makes sense in any market, right? In terms of, hey, the older you are, the less speculation you should have in your portfolio, and in general, the less exposure to stocks you should have. Um, but I'm assuming, particularly in an environment like right now, where valuations are as high as they are. I mean, we've had the major Wall Street houses, the Goldman Sachs's, the JP Morgan's published forecasts of saying like, hey, given where valuations are, we expect average returns over the coming decade to be single digits, low
Yeah.
single digits, maybe even some have said zero. John Hussman says less than zero. So, I mean, valuations are not a good timing metric, but they do give you a sense of the risk here, right? And they are sort of flashing red that like valuations aren't great for forward returns.
Well, if you look at the return, like for example, January 1, 2000 to 2012, the S&P was 1%. However, you had major ups and downs in that period,
Hmm.
and that's what throws people off. They'll have maybe a couple of periods where they go a lot lower and then they come back and they look up and you look up 5 years later or something and you haven't made any money. And you're like, well, wait a minute, all my costs are going up, and I'm not of the age that I can make more money. That's the
Right,
key right there. And I think people have to stop and think about that.
right. Well, and that's if their portfolio is flat and their costs are rising, that's not a good situation to be in. But as you know, a long period of flat returns doesn't mean the stock market went flat during that time. It probably gyrated around a lot. And so what really damages people is when they're in a down cycle and they're like, wait a minute, my costs are going up, but my
Yeah.
market value, my portfolio just went down 25%. And that's when they really start panicking and making the really damaging decisions, correct?
Oh, for sure. I mean, I can show you market examples of people that start at the wrong time or start at the right time when they retire, like with money in the market. If you start at January 1, 2000, you take out 4% a year, for example, and you look up, you look up 20 years later, you don't have as much principal. But if you started at January 1 of 2003, you have 3 or 4 times as much principal.
Hmm.
It's timing, but so you always have to have enough liquidity so that timing doesn't kill you. In other words, if you have everything in, your timing's poor, so you have to give yourself some options or it won't work.
So it is personally, this is why, I really favor the active approach going forward in this type of market, right? Where odds are looking higher than we'd all like that forward returns are going to be lower than normal. And it doesn't mean you can't make money in that market, but you have to do it by being smart and having a process that lets you determine when it's time to lighten up and when it's time to be buying back in. And of course, that's one of the specializations of your firm. Let me ask you this, Ted. You talked about how the average baby boomer return is 72 this year, the age at which you have to start
Or,
taking.
that, or actually next year, this year 71, but
Sorry.
yes.
Okay, next year, but coming
Mhm.
up soon. Um, I think you're familiar with Michael Green's framework of looking at passive capital flows and how that has created a bid under this market, right? He calls it the giant mindless robot. It's the massive amounts monthly that get put into the market to buy retirement assets, through corporate retirement programs and things like that. It's a price
Yeah,
blind purchaser, right? It just comes in every
right,
month, right?
right,
Um, so this required minimum distributions of the baby boomers is almost a bit of that in reverse, right? It's a price
yeah,
blind seller, right? So the more that the
right,
baby boomers age, the more that average age of the baby boomer gets more and more of the baby boomer cohort in it. That we used to see the stat that 10,000 baby boomers hit retirement age every day. Now it's going to be 10,000 baby boomers more are having to take required minimum distributions
right.
every year. Um, do you expect that to kind of be like a permanent or a long-term headwind on equities for as long as it takes that bolus of the cohort to go through?
Well, I do. And the other side of that is if you have a generally not so great a market anyway, you'll have pressure from the outside. One of these days, all the 401k people, and I know you've had some great interviews with Mike. I know him. He's a bright guy, and
Super
he's right
smart.
about this. If you look at just the average 401k person, they just do whatever the plan person tells them,
Right.
you know. And so if they get into a mode of where they're losing money, you can bet that they're going to make those allocation changes at the same time that you're trying to take money out over here on an RMD. And so those two could come together right there and create a change where all of a sudden, just like you're talking about, Adam, you have people taking out as opposed to putting in.
Yeah. Hmm. All right. It's going to be interesting to see the effect of that, and we'll track it on here in real time as it starts to happen. We're going to have to start wrapping up in a minute, Ted, just given the time wise. But real quick, is there anything that's really brightly burning on your radar that I haven't thought to ask you about yet?
Well, not really, Adam. I mean, you generally cover all the bases, as far
Okay.
as I'm concerned, for sure. But hopefully people will keep their head on straight during these periods in here, and really understand what they own. So that's been real important to them.
Okay. Well, I've got two questions for you as we wrap up, and they're both kind of around the high net worth client that you service there at Oxbow. I guess first question is, what's top of mind for high net worth investors right now? Are you seeing or hearing any feedback from them this year that's different from years previous? Is it excitement at pursuing future gains, or is it much more about protecting what they have? Is it something else? What is that successful high net worth investor really focused on right now?
Well, believe it or not, it's a couple things. Number one, most of the ours that are large investors, they wonder what's really going on. No, that
Hmm.
they don't feel like you have any particularly great leadership anywhere in the country or at the state level or at the local level. I think that bothers them as much as anything because they can see that not getting any better, just as a general look, we talk about it.
Yep.
And one of the things they always are concerned about, believe it or not, are their children. They
Hmm.
wonder about their children, what's going to happen in here, and they have this same battle all the time of how much should I give them money? If so, how much? Too much, whatever it is. And that's an ongoing thing with them all the time.
All right. For folks that might not be aware, Ted and I have talked about that particular topic an awful lot. He's written a book on it called Second Generation Wealth. We did a webinar on it. You can find all this in the history of the Thoughtful Money catalog if you go to YouTube or Apple Podcast or Spotify or whatnot. So if that's a topic that's of interest to you, I highly recommend you go listen to those discussions. Um, so uh, for one of the things that you guys have really focused on since the start in Oxbow has been the person who has come into a big liquidity event, right? So this is generally an entrepreneur who spent their whole life running a business, sold it, now sitting on a big pile of cash, doesn't know what to do with it. They've kind of lost their main reason for getting up in the morning. It's a very disorienting time, and it's a time where they really need to make some good, smart decisions for the long run. But this could also be somebody who's worked for a tech company that their options went to the moon, or it could be somebody who just came into a big inheritance or whatnot. Um, for that type of person right now, given the current conditions that we've been talking about in this discussion so far, because it seems like there's a bit more uncertainty, certainly than there's been in the past several years. Um, if somebody has just experienced a liquidity event or expecting one in the relatively near future, is this a time where it would benefit them to play a lot more defense than offense right now with that money, given all the uncertainty that's out there?
Well, I think you're right, Adam. And I love business people. I think they're the best investors we have probably in many respects. But if you've just sold a business or come into money or option, anything you're talking about that, you've just picked probably one of the worst times to have that liquidity, unfortunately. And that's the way the markets work, actually, because people are willing to pay high prices when times are good for
Hmm.
private companies, or that's when you get inheritance. People are feeling good about of what they're going to get, that sort of thing. But now's the worst time. And so if you've just come into a big liquidity event, it's all liquid. My advice to you would be if you want to invest a little bit of it, that's okay. But you need to really ice, I think, a lot of it and try to see what happens over the next 2 or 3 years to try to get your feet on the ground a little bit because things are really, really expensive right now. And this wouldn't be the time to allocate all that. You come out of something and then go right back into, the stock market or something like that. And then all of a sudden you lose part of it. It'll really affect you investing the rest of your life. So you have to give it time to kind of see how some things shake out in here because things are expensive. And you just picked a tough, it's one of the great times to sell a company because they'll pay you a lot of money for it. But it's one of the worst times to have the liquidity too, even if you inherit it or have stock options or whatever. The reason you have those stock options is because the price is up. So you have to remember that and really use that to your advantage.
Okay. And presumably, if somebody's watching and they fall into that category, um, your firm would be happy to sit down and just have a conversation with them to kind of help them think through their options. Again, this is sort of what we do here at Thoughtful Money is these connections. So in other words, this wouldn't cost them anything. There's no commitments involved. But because this is your area of expertise, your firm could really walk them through all the different potential options that they should be thinking about.
Yes, we would be happy to.
Okay. I also presume too that what you just talked about, kind of like one of the worst times right now to think about deploying, or one of the worst times to deploy that capital that's just come in because of all the factors you just mentioned. That's got to also apply to the sad reality of widows and widowers, right? I mean, somebody who has just they've lost their spouse, particularly if the spouse was the one that managed the family finances,
Yeah.
and now all of a sudden you're responsible for all that. You don't necessarily really know what you have, why you have it. Maybe investing's not even your bag, anyways. This is probably a really important time for that person to say, "Look, I need to get some help in just figuring out how to safeguard this stuff so that if some of the things we talked about happen in the future actually happen, they're less vulnerable to it."
No question about that. I mean, we see a lot of situations where either the wife or the husband was the manager of the funds, okay, and then something happens to them, and so they're left with whatever they were doing, and they don't really have a good grasp on it to speak of, and that's when they need the help really. They need somebody to say, okay, this is what you own, this is what it does, this is what you can expect, and I think we've done a lot of work with people like that after losing one of their partners, and first of all, it's a big deal for them because they're in a grieving mode a lot of times for
Hmm.
a year or two, and they need a sort of a outside better set of eyes on things at the time where it's not emotional.
Okay, very well said. I've got another last question for you as we wrap up here. Real quick though, folks, if you fit in either of those categories that Ted just talked about, and you'd like to talk to him and his team at Oxbow, just fill out the very short form at thoughtfulmoney.com/Oxbow, and they'll be in touch with you right away. Ted, I know that philanthropy is a big part of what you sort of consider to be a rich life, and it's certainly been a big part of your life. And I'm trying to remember, you've been very involved in it's either foster care or adoption, and hopefully you can
Yeah,
clarify which of the
yeah,
two.
well, foster kids, foster
Foster
kids.
kids.
Mhm.
Okay. So I just want to end on this topic of philanthropy. One, share any thoughts about it and the role you think it should play in a rich life. But also, obviously, if you've got a lot of money, it's easy to write checks to organizations that you care about. For the person that doesn't have a ton of money, um, just speak to how they can still be a philanthropist. And it might not even be with money, right? It might be with their time.
Yeah.
It might be, I mean, fostering. It might be fostering a kid, right? I mean, so if you can, just because you're one of the people I know who has been such a great champion for philanthropy, I'd love to hear your thoughts on this.
Well, there's a lot of ways you can help people, I think. I mean, I think for people that don't have a lot of money, I think one of the things you do is you have a listening ear to people that have some trouble or something,
Mhm.
and they need somebody to hear them out and give advice or whatever. And then if you don't have a lot of money, just doing small things, maybe you have somebody that just needs a small thing, or you tip higher than you normally do. You do things that you can do. One of the things I found about giving is it all comes back to you. Emerson had a thing called compensation, Ralph Waldo Emerson, and it was about how it's all a big circle. And it really, really is. I find the more I give and the more I give to the people and the people in need, the more of it comes back to me. I don't really worry about giving it. And we have two of the largest foster child foundations in Texas. Uh, Both of them cover about 35 counties, called Foster Angels. But what we do there is, we are really directly helping kids. And I don't think about, and they're 501, so it's not just my money, but I'm just saying the thing about it is that if you give it, even small amounts, it will, when I didn't have any money at all, and I grew up poor, but I still did things for people and still gave money away. And believe it or not, I'd always get it back some way or another. And so my advice to people that don't have a tremendous amount of money is just do something. You'll be surprised. A lot of good things will show up in your life.
All right. Well, very well said, and a great sentiment to end on. So, folks, if you can, please join me in expressing your gratitude for Ted coming on and sharing all of his wisdom with us. Please let him know how much you appreciate that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to talk to the advisors at Oxbow, again, just go to thoughtfulmoney.com/Oxbow. Fill out the form there. The firm will be in touch with you right away. These discussions are free. There's no commitments involved. It's just them being as helpful to as many people as they can. Ted, we should clarify, while your firm is very generous and trying to help as many people as it can, you do have minimums there. What minimum should we let folks know, just so I'm not sending people over there who might get disappointed if they fall below it?
Well, and this is not we're not trying to, but it's not a haughty remark or anything like that. We put a lot of people on an account. Our average account's probably $4 to $5 million, but we have at least a $2 million minimum to have an account. And again, that's not because we're trying to cut people out, but we also help a lot of people that don't meet the minimum. They come in and we still keep them on all of the things we do because I'm trying to help them out, even though we're not doing it for them. I let them know everything we're doing, and they can be on our list. And I like to do that. I like to try to help people, even if they don't have enough money to be with us. They'll see everything we do.
Okay. Well, thank you for that. And again, for full disclosure, I am a client of Oxbow's. I've been for a while. Ted was very kind way back then and opened the back door of the firm for me because the minimums have increased since then. But yes, just being very transparent with folks, I am an existing client of Oxbow. Ted, I can't thank you enough. It's just always it's such a learning experience always talking from you. I love benefiting from your wisdom. I've really enjoyed benefiting from your friendship and your firm's partnership over the years. Thanks so much for coming back on the channel.
You bet, Adam.
All right. And everybody else, thanks so much for watching.
If the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
An official U.S. gold revaluation, raising reserve valuations to today's market rate, would inject immense book value into the Treasury, 3% of GDP, improve balance sheets, and reduce debt pressure. However, this accounting shift could undermine confidence in the dollar, causing investors to flee into gold, silver, and other non-dollar assets. If the dollar is redefined and devalued against gold, it would essentially devalue U.S. Treasuries and cause interest rates to spike soon after. Past gold revaluations, 1933 and 1971, acted as dramatic tools to address monetary crises, devaluing the dollar sharply and resetting economic expectations. Current parallels are being drawn to the 1971 Nixon shock and potential similar systemic shifts. Investors retreat from the dollar, shifting toward gold, silver, and alternative assets. Rafi Farber, the publisher of The Endgame Investor on Substack, explains that short-term fluctuations remain, with gold prices reacting to data-driven dollar strength. Still, markets anticipate rate easing ahead, which could favor bullion again. Commentators warn that even entertaining the idea of a gold revaluation points to eroding faith in fiat money and public finances. It's seen more as a Rorschach test reflecting systemic anxiety than a mainstream policy plan, but one that signals how close some policymakers are to the edge. The UBMA and COMEX are experiencing record delivery demands as institutions shift to physical gold amid concerns about counterparty risk. Historically, gold revaluations fuel inflation, but a move today could be far more severe, potentially undermining the dollar's fiat status and forcing a systemic reset in gold and silver terms. This comes as de-dollarization accelerates, with gold overtaking the euro as the second largest reserve asset and central banks buying at record level. Watch closely for our professional insight. Click the subscribe button and enable notifications to ensure you don't miss any upcoming material. Thank you so much for your support.
August 1st, some guy who works for the Fed who has a degree in BS economics. I know it's a BS in economics, but what's the difference really? He published an article on the Fed's website about the prospect of gold revaluation and previous gold revaluations that have happened and how they basically had no effect on anything important, except the three cases of gold revaluation that he cites are completely insignificant relative to the ones that he does not cite, and those are the one in 1933, which revalued gold 66% higher from 21 to 35, and the devaluation of the dollar in 1971 relative to gold when the final gold window was finally closed. But he doesn't mention either of these and their effect on inflation, or what he calls inflation, which is the rise in consumer prices. I will show you how gold revaluations severely affect price inflation as defined by the Keynesians with two simple charts, and why this gold revaluation, if and when it happens, is going to be at least 60 times worse because the revaluation would be a mark to market, and even assuming the market price remains at 3,400 whenever this passes, and it won't remain there, the effect of a gold revaluation on the dollar and prices will be extreme, and it will lead to the end game almost certainly. One thing I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate, which we'll get to in the next chart. With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Now it's $3,400. So what would that mean? If you read this article, which I'll put in the link in the description below, it's full of a bunch of crap, which talks about some insignificant gold revaluations in the past few decades, but totally ignores the big one in 1933, 1934 of $21 to $35 a troy ounce, and then the big one in 1971 from $35 per troy ounce, or $42 per troy ounce, to whatever the market says, which was a gold default. What happened to prices in both of these circumstances? We're going to look at food prices in the immediate aftermath of these revaluations. You'll see it's not good. Here's what Craig Hemke says on the situation. I will link his article in the description below. In the end, Craig says, connecting all the dots for this picture is about as simple as a children's workbook. The politicians are warning you that an official gold evaluation is coming, and the price action since Trump was elected is telling the same story. The only question, what becomes of the market price for gold when this official revaluation happens? And he says, no one knows. Seriously. Well, I do. I just don't know exactly how long it's going to take from the official revaluation to endgame. I don't even know if we're going to make it as far as an official revaluation before the market forces it. But anyway, I'm going to finish this paragraph and then explain why I believe this is so. How could anyone be certain, as no one alive today has lived through the unofficial U.S. government evaluation? Well, I would say that we can still look at the data of an official U.S. government evaluation, and some people who are alive today have lived through it, those who were born in the 1920s and they're centenarians, and they were teenagers when it happened in 1933. Some of them are still alive, and we can find some of them. Anyway, if the U.S. just simply uses a London PM fix of, say, June 15th, 2026, and what does that mean for the gold price on June 16th? Probably nothing. However, it speaks volumes regarding the value of gold as something other than a barbarous relic. Additionally, other central banks and governments around the world may follow suit and issue their own official revaluations. Absolutely. If the U.S. government revalues its gold, of course, the other governments of the world will revalue theirs. And usually we're talking about the central banks here and not the government. But why do I think that the price of gold will head up higher very fast when there is an official gold revaluation mark to market? Well, here is some of the evidence, and then I'll give a logical explanation. First of all, the gold revaluations and inflation below was a 66% revaluation. This one would be 60 times larger than that, because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see these are food prices. I'm going into food prices because I want to know how a gold revaluation was followed. I'm not necessarily going to say affected by directly, but was followed by a huge spurt in food price inflation increases, which means that basic necessities got extremely expensive once the revaluation happened shortly after. You can see here that April 1933, food prices were going down 15.3%. By March 1934, less than 1 year later, food prices were rising at an annual clip of 22.3%. This was only on a 66% revaluation of gold, meaning devaluation of the dollar. Here is the August 1971 gold default. You call it a revaluation, dollar devaluation. It's all the same thing. The August 1971 gold default went from a 3.5% rate in food price inflation in August 1971 to 20%, 19.8% by August 1973. Just about 2 years later, we had the major stagflation of the 1970s, and the only way it was brought down was by the Treasury selling its gold reserves off to try to suppress the price of gold. And now, from a logical, positivist perspective, why would marking gold to market raise the price of physical gold enormously and then lead to huge amounts of food price inflation, which is really the most important part of the Keynesian definition of inflation, because when basic necessities become unaffordable, people start to riot? There are several ways to think of it. The simplest one is this, that gold at the Fed on its balance sheet is not convertible. You cannot go to the Fed with your dollars and get the gold that it has in its basement. What you can do is you can buy gold at a coin shop.
Farber turns to the present and notes that gold has been consolidating for almost 4 months. However, gold miners have already started to appear. In the past, gold has typically followed miners, who set the pace for upward mobility. While gold prices stayed mostly steady, mining equities increased by about 25% in August alone. With miners indicating the next step higher for bullion, that divergence implies the consolidation may be coming to an end. Discovery Alert notes bullish breakouts in miner performance relative to both gold and broader markets. The ratios of GDX gold and GDXJ gold are climbing from multi-year lows, suggesting that mining stocks are attracting capital away from traditional equity allocations, a sign of strategic rotation. Analysts warn that an official gold revaluation could trigger a massive dollar devaluation. This revaluation would be among the most dramatic ever, far outpacing the 1933 and 1971 gold devaluations. Still, experts caution that it amounts to more accounting ingenuity than genuine monetary reform. While it might help with short-term fiscal optics, the underlying risk to inflation, dollar confidence, and debt sustainability would likely remain unless paired with fundamental economic changes. Now, let's shift our attention towards the interview.
195 grams per ton silver at the galleon target, 3.8 grams per ton gold at the horseshoe target. We've got copper, zinc, lead, antimony, gallium, indium, and tin. Rumor has it that Putin will be there soon, and he might take a look at the resources. I don't think he actually will, but it's an interesting coincidence. Now that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian school positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they're both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed to cut rates 150 basis points. From Bloomberg, U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points, that is 150 basis points, lower than it is now. I think we could go into a series of rate cuts here, starting with the 50 basis point cut in September. That's what he wants. Bessent said in a television interview on Wednesday, if you look at any model, well, those models got to be hot. It suggests that we should probably be 150, 175 basis points lower. I wonder what model he's looking at. It costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backward-dated state. And another word for endgame is permanent gold backwardation. The gold that you can physically hold in your hand is worth $3,400, and that is the premium that people are willing to pay over the gold that you cannot, which is $42.22. Now, if they market to market, that means that gold that you cannot hold in your hand is worth $3,400. Then therefore, what is the premium gold that you can actually own yourself? Well, we don't know exactly what that premium is going to be, but it's going to be a lot higher than $3,400. And it could take a few days or a few weeks or maybe a month to catch up for the premium to start to rise. But recall that the strongest gold rally in history was from 1971 to 1973, which was even stronger in percentage terms than the rally from 1978 to 1980. I know often it doesn't seem that way, it's not thought of that way, but the strongest rally in gold was right after the revaluation or the devaluation of the dollar in 1971. We're going to see something very similar in gold prices if and when there is an official gold revaluation. The other way to think of this in terms of the Misesian regression principle is that all transactions in dollars are based ultimately on promises for gold, because that is how the dollar was born. And because all economic transactions today flow from all economic transactions in the past, it's like thinking about time travel. If you go back in time and change an event in the past, it's going to change all events in the future. So if you change economic events in the past, obviously they will also change economic events in the future. And the economic events of today are still based on the assumption that gold that is owned by the Fed is payable at 42.22 an ounce by dollars, which are the Fed's liability. I understand that people do not actually believe this, but because the economic transactions of today stem from those of yesterday and prices of today stem from prices of yesterday in gold terms, that means if the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
The possibility of a revaluation of U.S. gold highlights the financial system's severe structural stresses. Although doing so could momentarily strengthen the government's balance sheet, it runs the risk of inciting inflation, undermining trust in the dollar, and hastening the world's shift toward gold and silver. In addition to reflecting monetary history, the discussion highlights the vulnerability of the current fiat system in the age of de-dollarization, as gold miners have already signaled to the market that they expect bullion prices to rise. Would a revaluation of gold signal the end of the US dollar's position as the nation's reserve currency? Do recent advances by gold miners portend an impending bullion breakout, or are they merely another transient divergence? Post your thoughts in the space provided for comments. Join our community by subscribing to our channel and enabling notifications using the bell symbol if the video resonates with you. We appreciate your participation in our community.
The purchasing power of the dollar has lost is fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation, They lowered their U.S. GDP growth forecasts for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. I mean, this is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
I mean, Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what did they get? They got Hitler.
Germany experienced three stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned. And the third, from late 1921 to 1923, concerning parallels can be seen in the U.S. today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, Politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. I mean, you mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it, actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were three phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, and a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far, and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, everybody, including the large institutions, stand back and they don't buy treasury bonds. Certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. they're going to have to reverse that, or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. Because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.
First started being bullish on gold again. 150% from here would be talking about a $7,000 or $8,000 gold price. I'll tell you this much: if we have $7,000 or $8,000 gold price in the next 12 to 24 months, the world that we are living in, we're probably not going to be going out too much. We're going to have a lot more concerns than we have, because to be driven to that price in that short period of time, there would be some really, really serious issues. We're both coming back. I really like the way they're performing. I think $40 sometime in September is coming. That's a psychological number. Of course, the big number will be 50 and change. But I think the fundamentals for both gold and silver, technically and fundamentally, are firing on all cylinders.
Gold could theoretically climb to $7,000 to $8,000 within the next year or two, but such a rapid surge would signal major global turmoil, bringing far bigger problems than just high prices. On the other hand, silver is showing strong momentum, with $40 likely as the next milestone and $50 being the critical psychological level ahead. Both gold and silver are performing well, with their technical and fundamental drivers aligning stronger than ever, suggesting solid support for further gains. For most of his career, Peter Grandich, a market strategist with more than 4 decades of experience in the financial world, viewed silver as secondary to gold, but earlier this year his outlook changed when silver dipped under $30. Since then, he's become openly bullish on it, even suggesting it could outperform gold going forward, something he never expected to say. Both gold and silver have broken through key resistance levels and are showing strong resilience against intraday sell-offs, bouncing back quickly each time. With silver holding firm, he expects $40 soon, with $50 as the next big psychological level. Importantly, silver's supply and demand dynamics are now stronger than at any other time in his career, making the case for higher prices even more compelling. While silver's past highs, like $50 in the Hunt Brothers era, were distorted by unique events, the more recent $45 level is a better benchmark. Adjusted for inflation, silver's true all-time high hasn't even been reached yet, leaving significant upside potential. Peter Grandich points out that gold and silver miners are thriving, generating record free cash flow and strengthening balance sheets. Wall Street has historically ignored precious metals because they don't align with its financial asset model, but institutional interest is quietly building. As equity growth slows and the stock market peaks, mainstream investors will eventually be forced to take notice, potentially driving a powerful new wave of demand into the metals and mining sector. As we play snippets from the video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Including the blessing that I had for 25 years being at the Vancouver Resource Conferences. Silver was always second on my list. In fact, I used to say it was like kissing your sister. And of course, the silver bugs never liked that. But earlier this year, when it broke under 30, I turned bullish on it to the point where it was unheard of for Peter Granis to speak gold and silver in the same breath. And that remains so. In fact, I said then that I thought silver could outperform gold going forward. It is both gold and silver, as you and I speak here on this Wednesday. It is just trading picture perfect. It broke through key resistance. It tried to come back. I would say in the last 5 to 7 trading sessions, we've had attacks on both gold and silver intraday, and they can't even keep it down even intraday anymore. And so even as we speak today, it was a lot lower, and as we went to record it, they were both coming back. I really like the way they're performing. I think $40 sometime in September is coming. That's a psychological number. Of course, the big number will be 50 and change. But I think the fundamentals for both gold and silver, technically and fundamentally, are firing on all cylinders. And keep in mind, and I think this is important for silver particularly, the supply and demand scenario is far more favorable now than when it went to $50, several decades ago. So I think the fundamentals are much more underpinning for silver now than any other time in my career. And that's why I would consider myself a silver bug now, something that never existed before this year in my entire career. Far more important. The 50 was in the dinosaur days, even just before I started working in the business. So adjusted for inflation, that'd probably be half that number by now. The 45 wasn't that long ago. I don't think there are these psychological numbers, there's 45 to 50 that people would point to, but realistically, adjusted for inflation, the nominal high for silvers, we're not even close yet. So both it and gold, I think, clearly have 20% at least more in their price upside, and probably a little bit more for silver. What people seem to lose sight of is the gold companies are they're legally printing money in their free cash flow. I mean, it's an amazing phenomenon to see this. Even the ones that were weaker, their balance sheets are so much better and all. And we want to start talking about a couple $100 more on the gold price and maybe, $10 or $20 more on the silver price. What are these guys going to be like? I mean, they're going and the argument is, people say, will Wall Street ever get behind them? This is very important too. Wall Street, since the day I entered, treats gold and silver like kryptonite. It goes against the principles of what they make their living off of, selling financial assets. So don't ever expect to turn on major financial regular networks and hear large-scale speaking about this and all. Look at Newmont. We just said for the year it's been the second best S&P 500. If we did a trace and see how many times it was mentioned on any financial network, you wouldn't even need a calculator. But the ones that were 12th or 15th were spoken about 100 times. When they will come close to having to be involved in it is when the stock market peaks, and maybe goes down, but at least peaks. Earnings growth in general equities slows to a crawl or goes in reverse. And suddenly money managers are going to hear, what's this Newmont bat? These guys just went up 30 something, 8 straight quarters of record profit. Get me some. And why I know that's happening, from the institutional people that I can still speak to, especially the companies that go and been putting on and speaking at conferences. That's why these 2 shows in Colorado that are coming up in September are very critical.
Peter Grandich warns that while gold could theoretically surge to $7,000 to $8,000 within 2 years, such a rapid move would likely reflect a severe global crisis. He stresses that investing isn't just about gains, it's about avoiding major losses, which is what separates winners from losers. Even if markets decline, gold and silver are far more likely to hold value compared to stocks and bonds. He recalls advising clients in 2021 to move into physical gold, but only one truly listened, and that person is now far ahead. Bonds, once thought risk-free, have already dropped 30 to 40%, proving even safe havens can fail. For the next 12 to 24 months, Grandich says he would stake everything on gold and silver over traditional assets. Let's move back to the interview.
Let me put it this way. So 13, almost, well over 150% from when I first started being bullish on gold again. 150% from here would be talking about a $7,000 or $8,000 gold price. I'll tell you this much. If we have $7,000 or $8,000 gold price in the next 12 to 24 months, the world that we are living in, we're probably not going to be going out too much. We're going to have a lot more concerns than we have, because to be driven to that price in that short period of time, there would be some really, really serious issues. So in some aspects, I hope we don't get to that level. Okay? But where I think what you have to ask is, it's not, let me just throw 41 years of experience. It's not how much you make, it's how much you don't lose separates the winners from losers. It's very hard for people to understand that. But if you don't lose as much, that means you get to play a lot more, and then you have more chances of success. So what I think is more important to consider here is, what will end up better for me the next 12 or 24 months? Even if somehow they both go down, would one go down a lot less? Yes, gold and silver will outperform stocks. Give me an example. I hate to run on like this, but let me say this, Tara. So at the end of 2021, I'm part of a planning group. We have over $1 billion under management. We have some serious people with us. A third of my clientele are small business size owners throughout the United States. And I turned to them and I said, man, I think both stocks and bonds can lose money over the next 3 years. And I think it's better to own physical gold. You know how many people listened out of my entire clientele? Besides me, one person. Now, some did a little bit, but one person bit the bullet, got rid of their bonds, got rid of general equities, bought a lot of physical bullion, and now he owns a bunch of junior resource stocks. He never imagined he would own these type of stocks. But the bottom line is, it's inconceivable still for people. How do you lose money in bonds? When we were trained as stockbrokers, I'll never forget the sales manager always saying something like, talking about stocks, but if they're too concerned, buy bonds, because you don't lose money in bonds. Well, do you know that people that went into long bonds in 20 and 21 into 22, they're still down 30%.
Yeah.
30%. And as much as they can cut interest rates, if I'm correct, and the long bond rates go even higher, they could be down 40%. Now, yes, if they hold long enough and the government's still around and they can pay, yes. But that's unheard of. So I would tell you that as much as it's impossible for people to conceive, I think there's far less risk. If you took my wife or daughter, the two most precious things in my life, and said, Pete, pick either gold, silver, or stocks, or general stocks or bonds, I'm betting their lives on gold and silver, not stocks and bonds.
Peter Grandich's outlook highlights a turning point. Gold and silver are no longer just alternative assets, but essential tools for wealth preservation in a fragile global system. With silver poised for breakout gains and gold offering stability even in crises, both metals present stronger opportunities than traditional markets weighed down by debt and declining confidence. For investors, the real question isn't just how much they might gain, but how much they can avoid losing by positioning wisely now. Do you think institutional investors will accelerate their shift into gold and silver as equity markets slow down? Could silver's supply and demand imbalance make it the most explosive asset of the next bull cycle? If you like the analysis, then share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, Don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.